In September 2020, the United States Department of Justice announced one of the largest commodity market manipulation settlements in American history. JPMorgan Chase, the largest bank in the United States, agreed to pay $920 million in fines and penalties. The settlement resolved criminal charges related to years of deliberate manipulation of gold and silver markets. The bank's own traders admitted to placing thousands of fraudulent orders they never intended to execute, a practice called spoofing, specifically designed to move silver prices in directions that benefited the bank's trading positions. This is not a conspiracy theory. This is a confirmed, adjudicated fact. The Department of Justice, the Commodity Futures Trading Commission, and the Securities and Exchange Commission all confirmed it. JPMorgan paid $920 million rather than contest it. The manipulation ran for approximately 8 years, from 2008 to 2016. In the next 12 minutes, Signal Markets will show you exactly how silver price manipulation works, what was proven in court, what is alleged to be continuing today through different mechanisms, and, at the end, the signal that tells you when the paper price and the physical price finally converge. Stay to the end. Before we go further, nothing in this video is financial advice. Signal Markets is an educational channel. We analyze publicly available data, court records, and regulatory filings. Always do your own research and speak to a qualified advisor before making any investment decisions. This is part 2 of Signal Markets' 3-part silver series. If you haven't watched part 1, which covers silver's industrial demand and the global supply deficit, the link is in the description. To understand how silver can be manipulated, you first need to understand how silver is actually priced. The silver price that appears on your screen does not come from a market where people are buying and selling physical silver bars. It comes from the futures market. The COMEX exchange in New York is the world's primary silver futures market. A futures contract is an agreement to buy or sell a specific quantity of silver at a specific price on a future date. Most futures contracts are never physically settled. They are closed out for cash before the delivery date. The critical fact: COMEX silver futures contracts represent paper claims on silver. The volume of paper silver traded on COMEX on any given day is vastly larger than the amount of physical silver that exists in COMEX vaults. It becomes problematic when the paper market is used to artificially suppress the price of physical silver. Here is how spoofing works. The specific technique JPMorgan's traders were convicted of using. A trader places a very large sell order for silver futures, large enough to move the market price downward when other traders see it. Other market participants, seeing this large sell order, adjust their own positions downward. The price falls. The spoofing trader then cancels their large sell order. It was never intended to be filled, and simultaneously buys silver futures at the now lower price. The trader profits from the artificially created price movement. Between 2008 and 2016, JPMorgan traders executed this strategy thousands of times in gold and silver markets. The Department of Justice described it as a pattern of manipulation that spanned years and involved multiple traders acting in coordination. 3 JPMorgan traders were criminally convicted. The bank itself entered into a deferred prosecution agreement, effectively admitting the conduct occurred in exchange for avoiding a full criminal conviction of the institution itself. The $920 million fine was the largest spoofing-related penalty in U.S. history at the time. In a properly functioning commodity market, the paper price, set by futures trading, and the physical price, what you actually pay for a silver bar, should be very close to each other. Small differences exist due to storage costs, insurance, and transportation, but they should be small. In late 2025 and early 2026, something highly unusual happened. The paper price of silver on COMEX and the physical price of silver in Asia diverged dramatically. While COMEX futures showed silver at approximately $70 to $75 per ounce, physical silver dealers in parts of Asia and the Middle East were transacting at significantly higher prices, with premiums of $10 to $20 per ounce above the COMEX paper price being reported in Shanghai and other markets. The exchange for physical spread, which measures the difference between COMEX futures prices and London spot prices, expanded from a historic average of 25 cents to as much as $1.10 per ounce during recent tightness episodes, according to LBMA market analysis. Silver lease rates, the rate at which holders of physical silver lend it to industrial users, spiked to 39% in October 2025. In a normal market, lease rates are near zero. A 39% lease rate signals that physical silver is in severely short supply. COMEX registered silver inventory, the silver physically available for delivery against futures contracts, declined by over 70% between 2020 and early 2026. During the first week of January 2026 alone, 33.45 million ounces were withdrawn in 7 days. For years, JPMorgan was consistently identified in CFTC data as holding large short positions in silver futures. A short position profits when prices fall. Critics argued for years that JPMorgan's concentrated short position was being used to suppress silver prices. The CFTC investigated and ultimately did not find sufficient evidence to bring charges specifically related to the short position, though the spoofing charges confirmed the bank had manipulated markets through other means. Then, according to market reports and COMEX delivery data analyzed by multiple silver market analysts, something changed dramatically in late 2024 and 2025. JPMorgan reportedly began closing its short silver position and simultaneously accumulating physical silver through COMEX deliveries. COMEX delivery data showed JPMorgan issuing delivery notices, meaning taking physical possession of silver, at extraordinary rates. In January 2026, JPMorgan was reportedly involved in issuing 99% of delivery notices on certain days, taking physical silver out of COMEX vaults at a scale that has no historical precedent. Signal Markets presents this as what it is: publicly observable market data that analysts are interpreting as a significant shift. Whether it constitutes further manipulation is a matter of ongoing debate and regulatory scrutiny, not confirmed fact. What is confirmed fact? JPMorgan paid $920 million for 8 years of silver market manipulation. The precedent exists. The capability exists. The motive, as always in markets, is profit. Let's connect all of this to the investment signal, the number that has historically indicated when silver is most undervalued relative to gold and most likely to reprice. The gold to silver ratio measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has averaged approximately 60 to 1 since the end of the gold standard in 1971. In nature, gold and silver occur in the Earth's crust at a ratio of approximately 8 to 1, meaning silver is actually rarer relative to gold in geological terms than the market price implies. In April 2025, the gold to silver ratio reached 105 to 1, one of the highest readings in modern history. At that ratio, silver was extraordinarily cheap relative to gold by any historical measure. What followed was silver's 150% rally through 2025, compressing the ratio back toward 50 to 1. Even at 50 to 1, silver remains historically undervalued relative to its long-run average and dramatically undervalued relative to its geological occurrence ratio. The inflation-adjusted all-time high for silver was set in January 1980. When the Hunt brothers, 2 Texas oil billionaires, attempted to corner the silver market. Silver reached approximately $50 per ounce in nominal terms. In today's inflation-adjusted dollars, that peak represents approximately $180 to $200 per ounce. Silver has never come close to reclaiming its inflation-adjusted all-time high. Gold, by contrast, has dramatically exceeded its inflation-adjusted all-time high multiple times. At the start of this video, I promised you the signal that tells you when the paper price and the physical price finally converge. Here it is. Watch the gold to silver ratio alongside COMEX registered inventory. When the gold to silver ratio is above 80, silver is historically cheap relative to gold. The higher above 80, the more compressed the eventual repricing tends to be. When COMEX registered silver inventory falls below 100 million ounces and lease rates spike above 10% simultaneously, physical supply stress is becoming acute. A market where paper claims on silver vastly exceed the physical silver available for delivery cannot persist indefinitely. At some point, the paper price must reflect physical reality. That convergence, when it comes, is what analysts are calling a once-in-a-generation repricing event. To be clear, Signal Markets does not know when this happens. Nobody does. Markets can remain irrational longer than investors can remain solvent. The manipulation case against JPMorgan shows that concentrated institutional positions can suppress prices for years. But the structural forces we covered in Part 1, 6 consecutive years of supply deficit, China's export restrictions, U.S. critical mineral designation, irreplaceable industrial demand, combined with the paper market dynamics we covered today, create a setup that has no historical precedent in silver markets. To summarize Part 2 of Signal Markets' Silver Series, JPMorgan Chase paid $920 million, confirmed by the U.S. Department of Justice, for 8 years of deliberate silver and gold market manipulation through spoofing between 2008 and 2016. 3 traders were criminally convicted. Silver is priced through futures markets where paper claims vastly exceed physical supply. This creates the structural possibility of price suppression through concentrated short positions. The paper-to-physical price disconnect widened dramatically in late 2025 and early 2026, with lease rates hitting 39% and COMEX inventory declining over 70% since 2020. COMEX delivery data shows JPMorgan apparently reversing from short to long positioning in physical silver, a publicly observable shift that analysts are watching closely. The gold-to-silver ratio above 80 signals historical undervaluation. COMEX registered inventory below 100 million ounces combined with lease rates above 10% signals acute physical stress. The signal to watch: gold-to-silver ratio and COMEX registered silver inventory simultaneously. Both are publicly available and free to track. Part 3 of Signal Markets' Silver Series covers the full investment thesis, price targets, how to access silver as an investor, the difference between paper and physical silver ownership, and the risk factors that could delay or prevent the repricing. Subscribe so you don't miss it. Link to our recommended platform is in the description below. As always, do your own research, and nothing in this video is financial advice. This is Signal Markets. Find the signal, ignore the noise. See you next week.